Taylor Perry, thanks for spending time to have a conversation here. Appreciate that.
Yeah, thanks for having me, Nick. Excited to be here this morning.
So your current title is Managing Director of A for Novastone Capital, right?
That is correct. Yes.
So why don't you start by telling us what is Novastone Capital and what was your career path that got you to where you are today?
Yeah, sure. So Novastone Capital, or NCA for short, is a financial services group that helps organize acquisitions of what we call small and medium-sized enterprises, which I'll come back to because I think these are not small businesses. These are real scaled businesses across the globe. So we are based out of Switzerland, but about half of our internal team sits in North America, mostly in the US, and then half the team is still spread across Europe. And to date, we've completed 22 platform acquisitions, which are standalone businesses. And we've completed a few additional acquisitions of companies beyond that, just to add on to those existing companies. We've also had the first exit in the portfolio recently at the end of last year. And my role specifically is to lead the acquisitions of these businesses. So we pair up with operators who we think are world-class individuals to go out and run these businesses. And some of those people have had acquisition experience before, but many of them haven't, because we're really looking for operators of businesses, not acquisition professionals. And so I lead the team that helps pair up with those people from the very earliest phases, which is going through a business they've come across and seeing if it hits on different things and aspects that we're looking for in a business to acquire, all the way to executing on closing the deal. So seeing wires of money go across the table to the seller of the business. And that's a pretty long process. It takes 3 to 5 months and involves many different parties, the selling side, us on the buying side, and all the different advisors. So just managing those processes. So that's where I'm at today. The team, the M&A team, which is actually, we're changing our name to the investment team kind of in real time, is about 12 people now today, including myself. And that includes mostly investment professionals, but then also our in-house legal team as well. And that team also sits both in Europe and in North America, like the rest of the firm that I mentioned earlier. So going back on my career, so I studied finance and accounting in undergrad. I was always one of those people just kind of inclined towards numbers, before going off to college. And so I kind of just fell into the business world. And as someone who didn't really know what that meant when I was, 21, 22 years old, I was honestly just kind of looking at my upperclassmen around me and seeing what they were doing. And I was fortunate to go to a school that had this kind of pipeline to New York City. I grew up in a pretty small town in Virginia. And so I also kind of always wanted to know what else is out there. And so I took an internship in investment banking and then ended up going back to that full time. And what that is, because a lot of people don't know what investment banking is kind of what I'm doing today, which is buying and helping to buy and sell companies, advising people who are selling a business or advising people who are buying a business. And so today I'm on the other side, which is the buying businesses side. So I did that for a couple of years. And from there, I then joined one of those big organizations that does buy businesses, which was a private equity firm in New York. And that firm was focused on buying large manufacturing businesses, specifically headquartered in North America, but had global operations, the firms they were acquiring. And they took a really operational approach. So that's been one theme as well in my career. I've always been more inclined to work with businesses that aren't just a numbers or a finance-based firm. So firms that actually want to have operators go into place in the businesses that they're buying. So I did that for a couple of years. I then went back to business school, got my MBA, graduated after that. I went back into private equity. Then I took shortly before COVID hit, this was like late 2019, I had kind of just an itch to do something a little bit more entrepreneurial. So I joined, I came across through just like a friend of a friend, an individual who was starting up a supply chain financing firm. So an existing market, but a totally bootstrapped firm. And what he was doing was providing basically factoring services. So it's just, paying for receivables, helping to manage cash flows, but doing that specifically with really early stage companies, which there weren't really many groups doing that. So I kind of hop ship, joined him to give it a shot. was a really interesting time. We kind of made it work for a couple of years. Again, we launched right before COVID, and it was very tough to be in that kind of business when you're in the era of free money and when, the government was just handing out, for real reasons, but handing out big loans to people. But we made it work for a couple of years until it didn't. And then, I popped my head back up to see what was out there. And by some just happy circumstances, I came across NCA as they were looking to hire somebody in North America. So kind of followed a bit of a traditional path in the world of finance for the first bit of my career. Took a little detour, which was fun and exciting, and then have found myself back here with NCA for the past 2.5 years now.
So up until that startup experience that you just mentioned, you sort of just answered it. Is that the normal career path for somebody wanting to get into private equity?
Yeah, that's exactly right. It's pretty standard. I think as time goes on, you start to see more firms out there taking people with different backgrounds, but the reality is that it's still a very traditional industry with a very set career path. You study finance and accounting, or maybe economics or mathematics, and then you go into banking for 2 or 3 years, and then you join a private equity firm. And that's a very set pattern.
So what are you doing in investment banking as, a person coming right out of school, basically at the beginning of your career? What are they having you do?
Yeah, so a lot of what would probably appear as busy work to outsiders, which is true to some extent, but anything and everything is kind of the answer. So, the teams within investment banks are very small teams. You might be working on selling a billion-dollar company, but the team working on that deal might only be 7 or 8 people internally at that bank. And so as the most, junior person coming in out of college, you're responsible for analyzing the company. So spending a lot of time in Excel, like digging into the numbers of the company, thinking about what patterns are there, how to present the business to potential buyers to make it the most attractive, but then also uncovering, hey, these are maybe some of the risks that a buyer might see, and how can we position the risks to show what the mitigants for a potential buyer might be. You're also analyzing the market. So you might be calling experts, on a blind basis, so they don't know who you are, just to try to get real insights into market trends. And you're also putting together really fancy presentations for people in the industry. We call them certified information memorandums, or CEMs, which are these big 50 to 100 page documents sometimes that just have a ton of information on the company. And that document is going to be the first heavy data touch point that a potential buyer will have. So it's critically important. And, it's funny looking back on it now, but in this industry, everything has to be, there's a drive for perfection. So you have to make sure there's a period at the end of every sentence. You better have the page numbers correct. And again, I can laugh on it looking back, but I understand it when you have people analyzing buying a business, regardless of the size, but even more so when it's a huge company. If you see something on a page, we're all human. If you see something that looks off, you're automatically going to question, okay, is the rest of this information true or not? So that's what you're doing in terms of actual production. But why it's exciting for a lot of people coming right out of college is you just get the opportunity to see every aspect of a business at a super early part in your career. And you really are responsible at the end of the day for a product that is going to go out there into the market. So you get to learn a ton. There's a lot of high expectations. And it's a bit of a just a really intensive process, almost like a boot camp, although I don't want to put an analogy to the military. It's definitely not anything like that, but it's a great way to learn a ton very early in your career.
And is this one of those roles where you're working 70 to 80 hours a week?
That is the stereotype, and it comes true for a lot of people. I think I lucked out. I was specifically in a restructuring group at a time when nothing was really getting restructured. And so we still worked long weeks, but it's probably a 60-hour week or so for me on average. But I have peers who I know were cranking out the 70 to 90-hour weeks. And every once in a while, you'd push past 100, which sounds crazy. And I think I had 2 of those. And so you can look back and sadly wear it as a badge of honor, I guess.
So in that normal private equity career track, how long does it take just on average to get to the partner level at a PE firm? Is it 15 years? Is it 20 years?
I'd say it's probably around that 15-year mark. And it's going to depend on how big There's these huge groups that manage tens of billions of dollars, and they're kind of their own group. That's a very tough career path to climb, and that might be a longer time frame. But what's kind of referred to as the middle market, which is a bit of a misnomer because these are funds that have anywhere from like $300 million to $2 billion. These are very large pools of money. You'll see typically people get into partner level if they make that climb in about 15 years is a good amount of time. And it's pretty set. Like there's normally 4 to 6 kind of levels within the organization, and each one typically has pretty set time frames.
So, I of course know Novastone because that's who supported the acquisition of my company, and you're on our board. To me, Novastone today very much looks like a private equity firm. It looks and feels like that from my perspective.
Yeah. And that's the evolution that we've gone through over the past, really since inception, I would say. And again, I've been with the firm for 2.5 years. When I started, there was no acquisitions yet in North America. So it was a pleasure working with you to get to the finish line on the first US acquisition. And today we're up to 9 acquisitions in North America. So Canada is involved here as well outside of the US. And in 2024, we did 9 total acquisitions as well. And in 2023, we did 9. And in the previous years, it was a much smaller number. So we're scaling, and we along the way have invested money into these transactions with a sister fund of equity through a family office that our founder also is the managing partner of. And we're actually in the midst of fundraising for essentially private equity funds in the US, one in the US and then one in Europe, which will, kind of obviously each invest in their own geographies. We will still not be directly comparable to a private equity firm because we'll continue to lead with our operators. And a private equity fund typically is acquiring 100% of the equity in a business they acquire. And that's not our intention here either. But we help organize these acquisitions. We stay involved after the acquisition, and we want to be able to put more money to work behind these deals because we believe in them. So we have a lot that rhymes with what a private equity fund does.
Well, doing close to 20 acquisitions in the past 2 years, I mean, that's impressive numbers in and of itself, but maybe also describe the model from the start, right? Where, NCA is supporting the acquisition entrepreneur from the beginning before they even have identified likely an acquisition target. So, and I know that you're supporting quite a number of people in the search phase now that are looking for that acquisition.
Yeah, absolutely. So NCA, this whole model is based around what are called search funds, or also referred to as entrepreneurship through acquisition. And so as that name implies, this is not starting up a business from scratch, but is finding an existing business to acquire and then run. And this business model has been around since the 80s. It kind of started out of, Stanford really has the kind of the holy grail on information and the model itself. And it came out of some MBAs who didn't want to go into consulting or go into banking. They wanted to do something a bit different, but they also didn't want to bootstrap a company. And so that's where the model really started in the 80s. And it typically was around those exact folks coming out of an MBA, maybe late 20s, 30 years old, not a lot of real experience. And we've taken that model, but applied it, as I noted earlier, to folks who I think are world-class operators who we refer to as mid-career professionals. So people with at least 15 or 20 years experience who have worked in businesses with a lot of responsibility, P&L responsibility, people responsibility, most importantly. And we support them so they can leave those jobs, which are often, high paying jobs where they're already on a path to see higher and higher positions within the organization, but they want to do something different. So they leave those jobs. They have 2 years with us to go out and find a business to acquire. And during that time, we are, paying a salary to support their living expenses. We're covering administrative costs, like they're hopefully traveling around, going to conferences, trying to create deal flow. Because when they start their search, they might know some businesses that are out there, but to find one that is, fits their background, is ready to sell, and fits all of the criteria we're looking for it's really tricky. to find that. So it's a really heavy lift for our searchers. And yes, to date, we've done 22 standalone acquisitions, probably closer to 30 acquisitions in total when we count add-ons. And we currently have about 35 operators or searchers out there looking across Europe and North America, and many active deals right now. So for 2025, we're trying to target closer to 15 acquisitions, then maybe a bit more in 2026. And then I think the idea is to kind of stabilize at maybe high teens, maybe 20 at the most acquisitions a year. And that's the program. So there's a lot that happens underneath that, but the idea is to support really high caliber people to kind of leave a traditional corporate path to do something more entrepreneurial, and then support them after they've successfully acquired a business. Obviously, our investors and ourselves, we do want some sort of exit to create liquidity. Our investors are kind of targeting 3 to 5 year investment horizons, which is also pretty common in private equity. But I think, we're a new program, but I think we're going to see a lot of our operators stay on board for the next round as well. Once we have some exit, I think we'll see a lot of our people stay on as CEOs into the future.
So there's a lot of variation of the search fund model, right? You could do self-funded, you could do traditional. There are certainly other accelerator-like programs that are similar in concept to Novastone. So what's the sales pitch for somebody, in my shoes, wanting to do a search fund to partner with Novastone?
Yeah, I think the sales pitch today is that we are bringing all the resources around you that you're not going to have independently, and you might not know that you even need yet, combined with scale that we've achieved to date. So maybe this has evolved, a few years ago when you were considering the program. Obviously, it's a very different position, no acquisitions yet in North America. But I think there's a lot of potential. Your ultimate goal is to find a business to acquire and run. And there's a lot of individuals that you kind of refer to as independent sponsors that are out there at this end of the market looking to acquire businesses. And they get a bad reputation because they often will show up to a seller, make a bunch of promises about how they'll be able to execute the transaction, get to the finish line, and then that doesn't actually happen. And so now with the scale we have behind us, it really adds confidence to these sellers that we can actually do what we say we're going to do. So that's really important. But then, as I noted, searching you don't know what resources you're going to need. You can do all the research beforehand. I trust the people in our program absolutely do that. But like with anything, you don't know until you actually get into it. And we have a lot of resources in the firm. So my team, the investment team, we're the acquisition experts within the organization. Again, a lot of our people in the program just don't come from acquisitions. And we don't really want that either. We want people who know how to run an operating business. And so we're there, we've now been through 20 plus of these processes directly with NCA, but then most of us come from backgrounds where we were doing this before too. So we have that experience. We have relationships with lenders, which is another difficult thing to do if you're looking out there independently. We have in-house legal counsel. We have a data team that helps create a pipeline of opportunities. And so there's other groups out there that provide similar services to us, like some of those accelerator groups. We're trying to do the same, but doing it at scale. And I think we're showing we can do that now with where we've gotten to over the past few years.
No, I think that's exactly right, because I remember when we were in the details of this acquisition, a lot of time was spent with the broker representing the business, but also the seller, to convince them basically, do you guys have any money, right? Can you actually get a deal done? We just spent a tremendous amount of time getting over that hurdle before we could actually get to like the LOI stage and everything that follows that. You mentioned right at the beginning that although we use the term, SMBs here, what Novastone is really doing is kind of upmarket from a traditional search fund, right? So another selling point is the opportunity for folks like myself to acquire larger companies than you would in a normal search fund. So maybe tell us a little bit more about that, like the size of companies that you all are acquiring and operating.
Yeah, absolutely. So that's right. I refer to them as, small and medium enterprise, but I think when people hear that word and they're not directly from the industry, you might think this is the laundromat down the street. This is the car wash. That's not where we play. And that's not necessarily where a traditional searcher would play either, but the traditional searcher might be looking for a business that does, $2 to $5 million of revenue. That's a real business. So it's kind of funny to even refer to that as a small business, because I at least personally think of like the local restaurant, right? Which they might be doing 2 million in revenue too. But that's kind of the traditional searcher target. We at NCA, that's objectively below where we will approach companies. So on the small end, in terms of revenue, $8 or $9 million of revenue, but really we're looking for 10 and above. And on the high end, it can go up to $75 million. So, these are opportunities that when a few years down the road, our operator has had the chance to execute on their value creation plan, we could be exiting these companies at, 9 figures of revenue, like north of $100 million. So these are really large organizations. And yes, that certainly lets us differentiate. Traditional searchers typically going to get bank financing through what's called an SBA loan, which has like a personal guarantee backed by, but it's a government supported program, and it'll let that searcher finance, sometimes up to 85% of the deal through debt. And then they'll raise some money from friends and family. Whereas we're bringing more institutional groups, so family offices, our own related funds. And then the banking partners we're working with these are real banks, some of which are, maybe not household names, but names within at least the finance community. Professionals would automatically recognize those groups. So yeah, we're trying to buy a scale in terms of the acquisitions we do, but also still stay a little bit below where there's traditional private equity groups. So we think this is a part of the market that doesn't have a lot of good buyers yet, and we're trying to become one of those great buyers within this part of the market.
Well, that's what I was going to ask, because I would assume at those revenue ranges and enterprise value ranges that you would be competing heavily with private equity, but is that not the case at this point?
We do from time to time, but it's pretty uncommon. And you will sometimes see us competing with more like regional private equity groups. And sometimes this might look a little bit different from like a traditional private equity group and operating out of one of the big cities like New York, LA, Miami. Sometimes they kind of operate more as a holding company and will acquire businesses in their specific region. So we do from time to time, but I would say more often than not, we're competing with strategics in the space. A business, might be for sale in Atlanta, but private equity is not looking at them, but maybe their competitor down the road in Macon, Georgia, is taking a look at them. So that's who we're competing against more often. But private equity from time to time, but we tend to stay a little bit below the size thresholds.
Well, when you hear the term strategic, oftentimes you think, well, there's somebody that's going to overpay, right? So are you not getting price pressure competing against strategics?
That can certainly happen. But there's also instances where, again, at the size of companies, I used Atlanta as the example. Well, more often than not, the companies we're looking at are a little bit outside of like a major city, and the strategics might be the only other person in town, and they're willing to pay a price, but they also understand that seller might not have other great options. And so that strategic doesn't necessarily have to overpay. But in a traditional sense, in financial markets, the strategic normally is going to overpay. When private equity is working on multi-$100 million deals and a strategic comes in, more often than not, that strategic's going to outbid everybody. But at this end of the market, it's actually a mixed bag, which is interesting.
Well, the other, I think, interesting sales pitch that we take here is we're looking for companies to acquire where the owner is likely looking to exit the business, right? So in a traditional private equity, they want the owner to stay on for another 3 to 5 years. But those aren't the situations that we're looking for, and we can uniquely solve, right? Because it's the person in my role that's going to step in as the new CEO.
Yeah, and we hadn't really touched on that point yet, but that's a critical part of the program, right? A private equity buyer, and even a strategic, but a private equity buyer absolutely is going to make whoever owns the business keep operating the business for at least a few years. Unless, sometimes families do transition and bring in a real management team, but that's pretty uncommon. It's just not something they're thinking about. To them, this is their business. They don't ever see a time when someone else is going to own the business until it's too late. And they're like, whatever life circumstances have come up that bring them to that point. And at that point, the idea of working for another 3 or 4 years and it's not your business anymore, that's a really tough proposition. So we offer a very unique type of buyer. And that allows us typically to buy these businesses for a slightly better price than we're typically not the highest bidder on these companies, but the sellers see the value in being able to step away right away. And not entirely. We do want to make sure the transition is a well thought out, smooth transition, and we're still able to call on the seller if we need them in the future for something. And again, these companies it's their life work, right? So they want to provide that too. But this whole aspect of letting people retire very shortly after the acquisition it's a rare benefit. You really can't find it with another type of buyer.
Yeah. And that was certainly the case here with our company, right? The owner was looking to retire. He had a lot of activities outside of work and wanted to go enjoy that. So we could step in and solve that for him. Now, I know part of your role is post-acquisition. You personally are taking a board seat on a lot of these portfolio companies.
That's right. So I sit on 4 boards today, and we have a team also internally. We call it our portfolio management team that we're building out that takes a lot of the board seats as well. So again, we're not a private equity fund, so it's not one group dictating actions to be taken at the companies, but we have a seat on the board, and we put a governance structure in place on each acquisition to make sure that the equity holders of the business have their interest represented. So NCA equity investors, we're all putting a lot of trust in our CEOs and our operators. And we've done that from the point we brought them into the program to hopefully putting them in seats as CEOs. But we do have governance structures in place because there is a lot of money that has been invested in these businesses. And we just want to make sure that our CEOs have support and it's not them just having to run everything by themselves. We hopefully are there to act as a sounding board on big decisions or even small things, or just to vet maybe. It's because when you're the CEO of a company, I've never been in that position, but you're one of one, right? So hopefully we are good partners to our operators in that way.
So in these board roles and board meetings, I'm always, personally challenged by how to make those meetings worthwhile, not only for you all, right? Because you're spending a lot of time to support us as you described, but it's a tough balance, right? So from my perspective and our management team's perspective, it's real easy to just throw up 100 PowerPoint slides and lecture to you for 4 hours, but I'm not sure you get much out of that. And I'm not sure we get much out of that. Like, what do you see makes for a very valuable board meeting?
Well, I think one thing you've done, which is great, and I see a lot of folks do this as well, but not everyone, is bringing in the other management team members into these meetings. Some CEOs like to keep it just them and the board, but I think bringing in the people around you in those top positions on other teams is really critical because it lets us hear kind of the updates on the company, not just from yourself, but from those people directly. So the people kind of running their individual functions every single day. And, that's also an opportunity for them to have access to the board. So it's not the board's members are all dialing into a call or they've all flown into town this week. And it's not this strange thing. Like we're real people. We're in the room together and we all kind of have the same goal, which is to help grow the business. And so I think that's just great in involving more people into the room. And you're right, there's a balance between just tossing hundreds of pages up versus talking about, specific action items that need to get done looking ahead. But you do have to balance kind of an update of what's happened in the last quarter. We're not only talking during these board meetings, so we're emailing, getting on phone calls between board meetings, but those tend to be more like targeted towards specific issues when you're having those conversations, right? And so at each board meeting, there is some element of having to kind of just bring the board up to speed of, hey, this is what we've been working on for the past quarter. But there's balance there because, yeah, to some extent, it's taking time away from you all, from your real jobs to kind of prepare some slides. So I think we found a healthy balance of kind of going through what's happened in the last quarter and then spending more time like looking ahead and just slides are prepared, but when we're in the room, just having conversations more with you, with the management team, and talking about how we can get better for the next quarter or year ahead of us.
Obviously, without giving too much of specifics, have you had a situation where maybe the CEO or the company was faced with maybe a significant challenge. Maybe their revenue went down significantly from one year to the next, or another situation where the board really had to support that CEO, that company through a really challenging time.
Yeah, we absolutely have. So I'd say we've had situations like that on both the more happy and exciting side, but then also the challenging side. And we do have some businesses in the portfolio that are in some more cyclical industries. And so, over the past year, we've had one or two of those businesses have exactly what you described, like seeing a big drop off in revenue and profitability. And in those times, we've had to, not run into any huge crisis, but we've had to work with our lenders because, your covenants might get a little bit, you have certain financial metrics you have to abide by when you take out a big loan, right? And those covenants may have gotten a little bit tighter. So as a group, our CEOs have sought out the support over the boards, and the boards have actively given the support just to come together as a team and game plan together on how to get through that. And the positive thing is, when you're in cyclical industries, you're always going to go through phases like that. It's inevitable. But the good news is that it's just a testament to how good of caliber of talent our operators have. We're growing market share, and in the instances that that are coming to mind right now, the whole market is down. That's really rough, and we hope that they turn around sooner than later, of course. But in these down periods, our CEOs are crushing the competition. We want all these businesses to get through tough times, of course, right? Because these are real people working these jobs. But during tough times, there's opportunity to gain market share and make a name for yourself in the space.
I mean, it certainly sounds like a really fun and diverse role that you have. I heard somebody once describe that, in a deal team where you have the CEO and you have the lawyer and you have the private equity person, like everybody wants to be the other role, right? Because it all sounds so exciting. The lawyer wants to be the CEO wants to be the private equity guy, and so on, just because there's a lot of really interesting skills to bring these things together and acquire a business. So what do you enjoy most about your role currently?
Yeah, it's kind of on that point you're touching on. I mean, I think I always was drawn. I think I kind of fell into this world even going way, way back, just because I was one of those kids that didn't know exactly what he wanted to be. And it was everywhere from pilot to doctor to business. And this is a role where I get to see so many different types of businesses, and I get to meet with real people too, which, so I did follow that traditional career path for a while, and I worked at a multi-billion-dollar fund, and we bought really, really big businesses, right? And like on the other side of the table is just another C-suite group, and like that real polished corporate stereotypical, everyone's got the perfect suit. At this end, you're working with mostly families, or just an individual who started a business from scratch 30, 40 years ago. And the employees in the business have worked with that type of person too. And that to me is it's a lot more fun. And that's why I call them, these are real people. It's not the corporate suit who has just, everything has to be politically correct within the organization. You say the right things, you look the right type. It keeps it a lot more fun when you're working with people who come from these types of businesses. And I get satisfaction out of knowing that their businesses are finding a home for the next phase, because like every family eventually is going to have to pass their business on. And there really aren't a lot of options out there. And it's nice. I have some small family businesses in my own background, and I've seen, and our founder has the same story. I've seen what can happen if you don't really have a good plan. And sometimes it's fine. It's easy enough. It works. But then other times it's not so good. And a store gets shut down a few years after you sell it. So I get personal satisfaction there, but it really is fun just looking at so many different types of businesses and meeting the people within them who have been a part of their journey, and thinking about how we can continue that legacy on.
Yeah, you're right. We are all going to exit our business at some point. It's inevitable. And so it's, what are the terms of that exit going to be? I think the Novastone model, it's a fascinating model. I was searching for a business for probably 18 months on my own before finding Novastone. I literally found it from one of their LinkedIn ads. And to see what it has become since when I was part of the program to now is quite impressive for what you all have done. It's a really, really compelling business model and value creation for folks.
Well, yeah, thanks very much. Appreciate that. And thank you for being part of the journey. Like I mentioned earlier, you were the first deal to get to the finish line in the US, which was a big moment for us. I think I had only been at Novastone for maybe half a year at the most at that point. So it was exciting to work with you from the start. I'm excited about where Enzo is going into the future and it being part of NCA, because I'm bought into what we're doing, and I think a lot of folks are seeing where this can go. So appreciate the kind words and very much glad that you're a part of this journey as well.
Yep. Appreciate it. Thanks for spending time with us.
Great. Thanks, Nick. Appreciate it.